Now we're going to study one of the most important aspect of a project management, that is cash profit versus book profit analysis. Before we proceed with the actual differentiation between the two, let us understand what is meant by book profit, what is meant by cash profit, and then we'll have a clear understanding of what is the importance of comparison and knowing both of them. So, what is a book profit? Book profit means the profit which is reported by the books of account based on the financial accounting. Okay. Now, the entries which are posted in the books of account, the transactions which are posted as a books of account are based on an accrual basis of accounting. Remember this term. The books of accounts are built up on the principle of accrual basis of accounting, which follows a matching principle concept. So what does this concept state? This principle of accrual basis of accounting states that the income which are earned during the period, okay, irrespective of the fact whether they are collected or not, the income which are earned during the period should be reported in that period, and expense which are incurred during the period should be reported in that period itself, to make sure they are matching. The transparency is there, a true and fair representation is made for the period of accounting. So I know the accounting language might be a bit complicated. Let me try to simplify it by giving an example. Suppose the organization pays its employees on the 5th of the next month. The salary, the payroll due for the month of January is paid on the 5th of February. In this case, when the company makes up its accounts on records its expenses in the books of account on January, it will also include one line item, that is salary expenses for the month of Jan, irrespective of the fact that they are being paid in the month of February and not January. That is called accrual basis of accounting. The expenses are recorded when they are incurred. Their date of incurrence is important, not the date of payment. Similarly, when you close a contract and you generate a sales invoice in the month of January, which is going to be collected after 2 months of rate period, say in the month of March, you still record the sales invoice in the month of January to make sure the period in which the sales has happened, the period in which the sales was closed, is recorded in the same period and not when the cash is ultimately collected from the customer. That is what is meant by book profit. When you incur an expense, you record it an expense. When you are liable, or sorry, when you are due to receive a income, you for a particular period, you make sure the income is booked in the same period, not in the future period when it's actually received. Now, based on this income and expenses analysis, you get a profit or a loss amount. That is called a book profit or a book loss amount, okay? Because it's based on the booking of the accounting system. Now let's understand what is a cash profit. Cash profit is entirely reverse of the accrual basis of accounting. Here you follow a cash approach. That is, irrespective of the fact when you made a sale or when you incurred an expense, you book a sale or an expense only when cash is actually going out or it's coming in. So continue with the previous example. Let's say you had booked a sale on the January, but the collection came in month of March. So when you're following a cash profit system, you will record the sales amount only in the month of March when you actually receive the cash. Similarly, for the expense of payroll, which was incurred in January but paid in February, you will record the cash expense for the payroll in the month of February when cash actually has gone out, not in the month of Jan when it was actually incurred. Now, I hope till now you got the point that both of the system will result in a different profits amount for the projects, okay, for any entity. Now, what is the importance of knowing both the things? We'll just look at an example and that will give you a clear insight as to what is the need for having and understanding of both the cash profit as well as the book profit. So let's see over here. One second, I'll just make one quick change over here because you will need this files for your record. Okay, so let us understand. We'll take this thing over here, the same part, line items over here. Book profits. Okay, just remove all the colors. We don't want any fancy thing going on for this one. Okay, here we have book profits. Here we have cash profits. Okay, so for the book profit, we made a sales of $800,000 over here, against which the expense incurred was $300,000. So now your gross margin is supposed to be total revenues less the cost of revenues. That gives you the gross margin. Now, based on after the gross margin, you have an operating expenses which were $220,000. Okay, so that gives you the operating income of $280,000, and then you have the other expenses for, let's say, $10,000 only. Okay, wait a second. I'll just put one more line item over here, which will be other income. Let's say this was $20,000. So now your net income is going to be operating income plus other income minus your operating expenses. That is $290,000. Okay, so this was based on the book profit. Okay, here you recorded all the expenses which you incurred in the period. Let's say for month of January 2018. Here you recorded all the expenses which are incurred for the period Jan 2018 itself. Okay, now we'll jump on to the cash profits. So in the month of Jan, the company collected a sales amount, cash account receivables from its debtors at sum of rupees $400,000 only. So understand this thing, even though the sales are $800,000, it is not recorded at the entire value. It just recorded the amount of collections actually realized from the customers. Here, and you paid, the company paid, let's say, an expense of $275,000 only. It has a credit of $25,000 still due in its account. So it's just going to record an expense of $275,000. That gives the gross margin of $125,000 compared to the $500,000 over here, because the company is not accounting for the sales or for the credit sales over here. Operating expenses, let us say it's supposed to be $200,000 over here. $20,000 is still outstanding, but you only account for what is actually paid till now. That's $200,000 over here. That gives you the operating income, a loss of $75,000. That means it states that the company paid $75,000 extra from its own pocket. It accounted a loss till now. Other income of the $20,000, you realized, let's say, half of the amount till now, and other expenses you paid $7,500. Let's say, keep it safe, $6,000 a year. So now your net income will be operating income plus other income minus other expenses. That is $71,000 over here. So if you see the difference over here, you received an income of $10,000, you paid an expense of $6,000, the balance is $4,000. That is an extra income. So that goes to reducing your losses of $75,000, and that gives you a cash loss of $71,000 over here. So I hope this was clear to you. What's the difference between the cash profit and the book profit? Now we'll just see what is the importance of this both things over here. The key difference over here is that an entity or a project manager has to strive to make sure the gap between the cash profit and the book profit is the lowest, as low as possible. It's really going to be the same one, because you don't get the entire collection and you don't pay all the expenses in the same period. But the project manager needs to strive for reducing this gap as much as possible. Why? Because even though if you are selling, if your project is doing great, it has a great profit margin till now, but if the cash profit is less, that means the collections are not happening as quickly as it should be within the credit terms of the company's defined credit terms or the industry credit norms. Then you are losing out on the opportunity cost of the project. Then you are incurring your own expense, own cash flow. You're burning out, you're putting a hole in your own pocket to make sure the project sustains and survives, which is also not a good sign. So by the analysis of this book profit versus cash profit, an entity, a project manager, is able to determine whether the credit period that has been given to the customers is a good one. Is it a reasonable one? Should they reduce the credit period? Should they take other better precautionary measures to reduce the credit period, to deliver better services so that the cash is collected quickly, to deliver projects on much faster pace so that they can realize the cash value, cash of the project or the proceeds from the project on a priority basis? The next aspect to compare over here is that try to figure out, are they paying up their expenses too quickly? Are they making the full use of the credit period provided to them by their vendors, by their suppliers, by the creditors? Or are they losing out on the opportunity of taking a full advantage of the credit periods? Now understand these things. In India, at least I know this thing, that many of the banks give you an option of creating an FD even for as low as 7 days with an amount as low as just 5,000 rupees, 5,000 INR. So if you have a spare cash of credit period of 20 days or 30 days period, that's the industry norm. And imagine if you have the cash lying with you and you can pay to your supplier, which is not going to give you any discount, any cash discount search. In that case, you can put this entire amount of extra cash, supposing they say $100,000, in a fixed deposit, and that will give you an interest for a period of 25 to 30 days for the credit period. And when that matures, the interest income goes to the other income, and you pay off your suppliers on time, maintaining a good relation, maintaining your credit reputations, and so on. At the same time, when you don't collect the cash from the customers on a priority basis, right, on the due dates itself, you are losing out the opportunity to earn the interest on those cash. It's ultimately adding another cost to the company. That is the opportunity cost. The opportunity lost to earn interest had that amount been invested by the company itself in a fixed deposit or any liquid fund and stuff like that. So that was important aspect to know what is a book profit, what is a cash profit, what is the importance of analyzing both of them, and how to try to struggle to strive a balance, or you can say close the gap as much as possible between the book profit and the cash profit, resulting in an overall profitability of the project itself. With this, we complete another important aspect, that is the analysis of a cash profit versus book profit. In the next sessions, we're going to be starting with the various ratios involved in the project analysis. Then we'll go ahead and see the various project evaluation techniques, which project to be taken on hand, which project meets the company's expected return on investment, and so on. And lastly, we'll have a look at how to budget for a project, how do you prepare a budget and forecast for the entire projects, based on which you select which project to take up, which project to be dropped off, and which project to be pursued at what point of time, and so on. Till then, I want you to quickly go through all the slides and examples and just understand what are the steps we took to recreate this entire things from scratch, the computations and all the stuff.